After forming a solid upward channel starting in June driven by a series of major partnerships across the globe, Plug Power finally began to fall, just like most of the market nearing August. But since selling volume has been relatively weak, let's look at some reasons why some Plug stockholders would choose to hold. Most recently in July, a conditional loan guarantee of $1.66 billion was secured from the U.S. Department of Energy to construct up to 6 green hydrogen plants, with the first plant slated to be built in Texas. This substantial government backing not only reduces financial risk, but also accelerates infrastructure development. Furthermore, the company has extended a strategic hydrogen supply agreement with a major U.S. industrial gas partner through 2030. This partnership ensures a steady supply of hydrogen, reduces immediate costs, and supports the company's expanding network of over 275 hydrogen-consuming sites. Benefits have also come from recent guidance issued by the U.S. Treasury regarding hydrogen tax credits. This guidance provides greater flexibility in power sourcing and broadens eligibility for tax credits, thereby enhancing project feasibility and investor confidence. According to CEO Andy Marsh, this development is a landmark win for both the company and the hydrogen industry as a whole. Looking ahead, Plug has set ambitious targets for green hydrogen production, aiming to produce 500 tons of green hydrogen per day in North America by 2025 and 1,000 tons globally by 2028. These targets are aligned with the company's sustainability goals, including reducing CO2 emissions from hard-to-electrify sectors. Then, the earlier multi-year agreement expansion with industrial giant Uline extends their partnership through 2030, including supplying up to 15 tons per day of green hydrogen and deploying Plug Power's fuel cell ecosystems at up to 10 additional Uline sites. This deal is a direct result of Plug Power's vertical integration strategy, made possible by the company's newly operational production plants in Georgia and Louisiana. By producing its own hydrogen, Plug Power can control costs and escape the volatile third-party fuel market, addressing its biggest historical challenge of poor gross margins. The significant year-over-year gross margin improvement seen in the first quarter of 2025 serves as early evidence that this strategy is beginning to yield results. Another major confidence boost came when Plug's chief financial officer, Paul Middleton, made significant open market purchases of company stock shares in May and June, demonstrating a powerful conviction in the company's Project Quantum Leap cost-saving plan and ability to capitalize on growing commercial opportunities.